Welcome to the Industrial Materials channel. This is your host Greg. The war in Ukraine throttled a flow of raw materials that was already being restricted by logical logjams, bad weather and other disruptions. The result was soaring prices. In March, a barrel of Brent crude oil hit $128 and European gas prices were 3 times higher than they had been just 2 months earlier. Copper hit a record price of $10,845 per ton. Wheat, corn and soybean prices rose by double-digit percentages. The surge increased consumer price inflation. This challenged central banks' credibility, giving another excuse to raise interest rates. Yet in recent weeks, the wind has changed. Oil is trading at around $100 a barrel. Copper has dropped below $8.0 a ton for the first time in 18 months. Metals in general have fallen by 10 to 40% since May. Agricultural commodity prices are back at pre-war levels. Europe's gas prices, which have continued to rise as Russia has cut supply, are backing the trend. The slide may fuel hopes that inflation will soon be defeated, but the victory might prove hollow if there is one at all. One explanation for tanking commodity prices is that worries about a recession are taking hold. In this view, rising interest rates are cooling the market for new homes, dampening demand for building materials such as copper and wood, and lowering spending on things like clothing, appliances, and cars, which in turn hurts everything from aluminium to zinc. Moreover, some of the supply constraints that contributed to price rises earlier in the year have eased. The weather in grain-growing region has improved, for instance. Meanwhile, the United Nations is trying to end a blockade on Ukraine's shipments of wheat. For central banks, this is mixed news. It suggests that inflation may be beaten even though they have only just begun tightening monetary policy. True, this might be accompanied by recessions, but because inflation would be tamed without interest rates having to rise too much, the downturn would perhaps at least be shallow. Worries about the economy are not the only force pushing down prices. Much of the money that has fled commodities belongs not to physical traders but to financial punters. In the week to July 1st, about $16 billion flowed out of commodity futures markets, bringing total for the year so far to a record $145 billion, according to JP Morgan Chase. In part, that reflects rising interest rates. In May, America's long-dated real rates turned positive for the first time since 2020. That made commodities, which do not offer yield, less attractive to speculators. This suggests that commodity price inflation may not have been slayed. Movements driven by real rate swings are usually short-lived. The last time one happened, in 2013, prices stabilized within weeks. Prices are also still sensitive to further supply disruptions. Commodity stocks remain 19% below historical average at a time of tight production, meaning there is less of buffer against shocks. Even as some supply problems have eased, triggers for others abound. Energy prices are still vulnerable to Vladimir Putin's whims. Pricey energy, in turn, would cause metals producers to trim output further, making production tighter still. And the return of La Nina, a harsh climate pattern, for the third consecutive year, could disrupt grain harvests worldwide. Prices, in other words, might stay tight even if recession hits.